In this video, I'm going to talk about a serious topic, which relates to the three fundamental things you must have if you want to make money in the financial markets with a sufficient degree of consistency and without taking unnecessary risks. You'll often see on the internet that everybody is after the secret method or the perfect simple trading strategy that will enable them to achieve their goals, which are usually utopic. What these people are missing is that trading is not just a matter of technical ability. It's a combination of three factors, and all three must be present if you want to make money in the markets in a realistic way. The first factor is capital. You need to have a certain amount of capital to extract a meaningful amount of money out of the market with low risk. The problem nowadays is that super high leverage has given the impression that you can make money quickly with as little as $50, for example. One of the problems with that is that to make that a reality, you will need to sustain a high-risk situation for a long period of time, and high risk is not sustainable. What happens is that people who attempt to do this end up making money quickly in the short term and then giving it all back to the market in a matter of minutes. There are more complicated reasons for why this happens exactly, but the main one is that high risk is not sustainable in the long term. If you want to make money with a very small amount of capital, you will necessarily have to use high risk. You will find plenty of stories of traders who multiply their accounts many times in a day, but you will not find the story of this trader with the same account a year later. The second factor is the method or the strategy. Every attempt to discover a method to make money in the financial market has one major goal, which is called variance minimization. In other words, how we can approach the markets in a systematic way to maintain a certain level of return while minimizing the risk. High return with high risk is the most obvious thing in the world, but as we already saw, high risk is not sustainable for very long. For example, in 1990, Harry Markowitz won the Nobel Prize in Economics for what became known as the modern portfolio theory, which is a mathematical way of minimizing the variance of a portfolio of stocks. In normal price action trading, tuning the risk-reward ratios of your trades will guarantee that you minimize the variance as well. My point here is that there are increasingly more sophisticated methods to take care of this problem, and some of them actually won the Nobel Prize. These methods all have something in common, which is the preoccupation with risk. What you see online nowadays is a preoccupation with reward. Anyway, that's also a long story that I'll get into in another video. The moral of the story is that you need a method that is sophisticated enough to minimize risk at the same pace that maximizes return. Most people online have no idea why that's important, and an even fewer number know what variance is to begin with. The third factor is personality and temperament. If you are hot-headed, impulsive, and hyperactive, you will have a really bad time in the markets. If you have that kind of personality, you won't be able to control yourself when you're winning, and even less when you're losing. The pernicious thing here is that you can have all the capital in the world and the best methodology available, but if you have the wrong personality, you will lose everything you have in the markets. People with this personality I just described have a much harder time controlling their heuristics and biases. The most important thing to realize here is that successful trading or investing is simply not possible in the long term without all of these three factors. Let's quickly analyze all the possibilities here and see what would happen. If you only have the capital, but you don't have the method, and you have an impulsive personality, you will lose money eventually because you won't be able to control your emotions, and you won't have a technical barrier to do that as well. If you don't have money and you have an impulsive personality, but you have a good method, things will not work out in the end because you will need to take high risks because of your lack of money, and your impulsive personality will guarantee that you can't control yourself when you're winning and when you're losing. You might make money quickly in the short term, but in the mid and long term, statistics will catch up and crush you, making you repeatedly go back to your starting position. If you don't have the capital and you don't have the method, but you have the right personality, you will also fail to make money because even though you have assertiveness and self-control, you don't know how to assess the market technically and you don't have the capital to do so. If you have the capital and a good method, but you don't have the personality, you will lose money because you won't be able to control yourself neither in good nor bad situations. Even though the necessity of high risk will disappear with more capital, you will still over-leverage your trades in both winning streaks and losing streaks because of a lack of self-control. If you don't have capital, but you do have a good method and a good personality, you simply won't go anywhere. Your method and your personality will prevent you from taking high risks, and with small risk and a small capital, your profit will be residual. If you have capital and a good personality, but don't have a method, you will simply be confused because you will have no idea of how to enter and exit the market, even though you will tend to maintain leverage under control. If you have all these three elements, you will hit the sweet spot to make money consistently in the long term. The combination of decent capital, a sophisticated method, an assertive, proactive, self-controlled, and disciplined personality will enable you to make money in the market. It's important to point out here that these rules apply if you want to transform the markets into your main source of income. If you treat the market as a secondary source of income or as a hobby, for example, then you don't need a lot of capital. If you have interest in learning trading methods that are realistic and have a good scientific background, check out the courses available in the video description. If you enjoyed this video, please help support the channel by clicking the like button, subscribing to the channel, and leave your comment below. Thank you for watching and take care.